I'm Adam Posen, president of the Peterson Institute for International Economics, and I'm delighted to open our second session of the third symposium on ending too big to fail. The series started by the Federal Reserve Bank of Minneapolis, and this third edition being co-hosted here and co-organized by the Peterson Institute. The highlight, obviously, from a newsmaker point of view, as well as we hope from an intellectual stimulus point of view, is the coming speech by President Neel Kashkari of the Federal Reserve Bank of Minneapolis. Neel took office as President CEO of the Minneapolis Fed on January 1 of this year. He serves on the FOMC. He is in charge, of course, of the bank and all its operations in the region. I enjoyed reading his Twitters from when he was out in Bakken looking at fracking and energy as well. From 2006 to 2009, Neel served in several senior positions at the U.S. Department of Treasury, obviously at a critical turning point for our and the globe's financial system. In 2008, after being confirmed as Assistant Secretary of the Treasury, he oversaw the Troubled Asset Relief Program, TARP, and received the Alexander Hamilton Award, the Treasury Department's highest honor for distinguished service. He worked at PIMCO after leaving Washington and explored public service, including through electoral options. Neel earned his bachelor's and master's degrees in mechanical engineering at the University of Illinois, Urbana, and his MBA from Wharton. This, of course, understates his record, and in particularly his willingness to bring issues to the fore, with credit, of course, to Ron and the rest of the Federal Reserve Bank of Minneapolis staff. Minneapolis has been a thought leader on issues of bank regulation and too big to fail for many years, but Neel has continued to build on that, and I welcome him to the podium for his remarks. Thank you very much.
Good afternoon. Thank you, Adam, for the kind introduction, and real gratitude for you and your colleagues at the Peterson Institute co-hosting this event with us. Scholars at the Peterson Institute have been leaders on financial stability and systemic risk issues for many years, and we're very pleased to collaborate with you on today's event. Before I begin, I have my own disclaimer, as you might imagine. I'd just like to remind everyone that the views I express today are my own and not necessarily those of the Federal Open Market Committee or the Board of Governors, which sets supervision and regulatory policy for the Federal Reserve System. Now, I come at the too big to fail problem from the perspective of a policymaker who was on the front line responding to the 2008 financial crisis. Over the past six years, legislators and regulators have worked hard to address too big to fail. My colleagues in the Federal Reserve have worked closely with other financial regulators to implement important tools and regulations that are making the financial system stronger under the reform framework that Congress established. Now, I agree that many current reforms are headed in the right direction, particularly those that make banks stronger with additional capital and deeper liquidity. But I do not think these measures go far enough. As a result, we are working on our plan to end too big to fail, and we are hosting a series of public symposiums, including today's, that bring together some of the foremost experts on financial stability, bank regulation, and systemic risk. And we have asked these experts to explore both the current and potential alternative regulatory frameworks to address the risks posed by large banks. Today, I will update you on that effort. Now, specifically, I will cover three main items in our initiative to end too big to fail. First, information from our May symposium makes me even more committed to recommending transformational solutions to address the systemic risks posed by large banks. What I heard suggests deep and broad agreement that the largest banks in the country are still too big to fail and that we need to act now to address this problem. Second, I will highlight some of the key takeaways from our first two symposiums that reinforce my concerns about current efforts to address too big to fail. I left our May symposium profoundly skeptical that current efforts will ultimately work. And third, I will end with important questions that have been raised in our initiative so far that require additional understanding. And then I look forward to having a discussion with Adam, Bertrand, and with everybody in the audience. Now, I started the Ending Too Big to Fail initiative knowing that we would have many supporters across the spectrum. Many others would also disagree with our effort. And not surprisingly, we have received significant criticism from the largest banks and from their lobbyists who would like to discredit this important initiative. But one of the main takeaways from our symposiums was the relatively broad agreement on some of the central parts of our effort. First, there was broad agreement about this. We need massive structural changes in our financial system and among large banks. Even those participants in our symposiums who express confidence in the current regulatory approach agree that a fundamental restructuring of the banking system is coming. They view such a restructuring as an indicator that the current framework is having the desired effect. Now, rather than the government deciding how to restructure the banking system, the new regulations will ultimately force large banks to restructure themselves. Indeed, there are examples already of large financial institutions beginning to shed assets in response to new regulatory pressures. Give it more time, these experts argue. Almost none of the experts we've consulted with believe the industry can and should stay in its current form. The only disagreement was about the scale and the speed of that restructuring. Second, large banks currently remain too big to fail. While a majority of experts on our bank resolution panel from our symposium in May expressed confidence that the new resolution framework would ultimately be effective for large banks, a majority of them also argued that if a large bank ran into trouble today, it would still need a taxpayer bailout because the implementation of the new regulations remains incomplete. Now, consistent with this observation is the recent result of the living will exercise. Of the 8 largest U.S. banks, both the FDIC and the Federal Reserve recently deemed the living wills of 5 of them, quote, not credible. 2 of the 8 other banks were deemed not credible by either the FDIC or the Federal Reserve, but not both. The living will of the one final bank, the best of the group, wasn't actually rated credible. It was just not credible. Let me say that again. It was not actually rated credible. The best of the bunch was just not credible. That doesn't inspire a lot of confidence. Third, we must act now to address too big to fail. There was also a shared concern that as memories of the crisis fade, the will to complete the implementation of current reforms, let alone introduce new ones, weakens. This outcome would leave the financial system exposed to unacceptable risks if reforms are left incomplete. Indeed, this is part of our motivation for our Ending Too Big to Fail initiative, to trigger a serious national conversation about the risks posed by large banks while we all still remember how painful the crisis was for society. A fourth point of agreement: we must stop risk from shifting in response to reforms. Even with a safer banking system in place, I too firmly believe we must take action to prevent risk from simply going to another corner of the financial system. Experts at our symposium seem to agree that some steps must be taken to actually reduce risk and not simply move it around. This issue of risk shifting from the commercial banking sector to the shadow banking sector is particularly acute in the United States. According to the Financial Stability Board, the U.S. has the largest shadow banking sector, with about $14.2 trillion in assets in 2014, representing more than a third of global shadow banking assets reported by 26 countries around the globe. Now, that's what we all agreed on. Important differences remain. There is more agreement than I expected on key reasons to move forward, but what I heard at our meetings confirms that I may have important differences with some colleagues about how much progress has been made and the best ways to address those differences. Many of these differences focus on the idea that we will solve too big to fail by imposing losses on long-term debt holders of large banks, the so-called total loss absorbing capacity, or TLAC plan, during a stressed economic environment. In a prior speech, I explained why I do not have confidence that the contingent convertible debt or other long-term debt included in the TLAC plan should actually count as capital, because I doubt it will actually face losses in a crisis. I explain why I believe it is a mechanism to spread risk rather than to contain it. So, why do I think that a plan that requires the government to stick losses on long-term debt holders during a crisis will not work? First, this approach is too complex and has too many moving parts to work when we actually need it to. Complexity is the enemy of a robust plan. Let me review the crisis response for a point of comparison. Arresting the 2008 crisis required the overwhelming force of the combined powers of the Federal Reserve, the Treasury, and the FDIC all firing in unison. Our solution was fairly simple. Put the balance sheet of the federal government behind the private financial system. We did that by providing as much liquidity as possible to as many stressed corners of the markets as possible, and by shifting as many potential losses as we could from the private sector to the public sector. It was extremely blunt, but it was ultimately effective. Do we really now believe that in the middle of an economic distress, when the public is looking for safety, that the government will start imposing losses on debt holders, potentially increasing fear and panic among investors? Policymakers didn't do that in 2008. There is no evidence that their response in a future crisis will be any different. When I heard experts describe the TLAC approach during our symposium, it sounded like a plan that requires everything to work out perfectly when we know that in a crisis, that never happens. A policy analyst recently asked me if we could really resolve a large bank during a crisis. I responded by asking him if he thought we could dismantle an aircraft carrier in the middle of a hurricane. It's not a perfect analogy, but he got my point, and I suspect you do too. Second, this approach leans too heavily on supervisory wisdom. One question asked about the TLAC at our meetings was, why not simply have banks' capital be entirely equity instead of both convertible debt and equity? An answer I heard from some regulators is that having a smaller equity cushion is actually better because it will prompt supervisors to act more quickly as the equity is erased by losses. At that point, the supervisors can move the firm into resolution, where the debt converts and becomes the equity of the recapitalized new firm, thus avoiding taxpayer bailouts. If supervisors had waited longer to act under this approach, the losses of the bank might consume the long-term debt as well, leaving nothing for recapitalization. I object to this approach for two reasons. First, it immediately reinforces my concerns about complexity. Second, this approach assumes that all-knowing, well-intentioned regulators seizing a bank earlier will somehow reduce the total losses the bank ultimately faces. I vividly remember the collapse of Bear Stearns in March 2008. In a couple of weeks, Bear Stearns went from normal operations to insolvency. Once the creditors seriously doubted the viability of Bear, the outcome was largely sealed. Closing Bear 1 week earlier would not have reduced the large losses Bear had due to its bad investments, which were made long before the stress became apparent either to management or to bank supervisors. We have very talented professionals in the Federal Reserve System and in other financial agencies, but we must be humble. We would not have had a financial crisis in the first place if government officials were wiser than everyone else. I've mentioned this before, but when I first went to Treasury in 2006, Treasury Secretary Henry Paulson directed his staff, including me, to work with financial regulators to look for what might trigger the next crisis. We looked at a number of scenarios in 2006, including an individual large bank running into trouble or a hedge fund suffering large losses, among others. I'm embarrassed to tell you, we didn't consider a nationwide housing downturn. It seems so obvious now, but we didn't see it, and we were looking. We should design our regulatory framework to assume that, as in 2008, regulators won't have better insights than market participants. We must assume that they won't see a future crisis coming until it's too late. Finally, this TLAC approach defies market logic. Part of the rationale for using convertible debt in the new regulatory framework is that it is supposed to be significantly cheaper than equity. Hence, borrowing costs for Main Street should be lower than if it were just common equity. But is this really true? On one hand, regulators are saying, believe us, contingent debt is as good as common equity. in its power to absorb losses if a bank runs into trouble. We will really force bondholders to take losses. On the other hand, the same regulators are saying investors will price these securities closer to debt than equity. But if these securities really do face equity-like downside risk, by the way, without the upside of equity, why would investors price them more like debt? I see three possible explanations. First, the securities aren't really going to face losses, so they aren't really capital. They will be cheaper than equity because they are really debt, which means they don't provide much financial stability benefit. Option two, the securities really are going to face losses, and investors will then price them more like equity, so there's little benefit for their added complexity compared to banks just issuing more common stock. Or number three, investors will misunderstand the risk and underprice these convertible securities similarly to debt, while regulators will really make them face losses like equity. It strikes me that a regulatory framework that relies on investors mispricing risk may work for a time, but isn't likely to work over the long term. Now, let's look going forward. Today's symposium is important because we are exploring in much greater depth, as we saw in the first panel, the trade-offs associated with higher capital standards. Increased capital in the form of common equity, not phony debt, solves many problems. It is the simplest and arguably the most powerful tool to make banks stronger. It can reduce rather than increase complexity. Its simplicity means that it also has the best chance of working over decades as the financial system evolves and new financial instruments are introduced. Higher capital may also reduce pressure on supervisors. Now, as we heard today, more capital has downsides that needs further exploration. In particular, higher capital could raise the cost of lending and potentially reduce economic activity. But to what extent, and how should we measure such costs? And that's why I'm so pleased that with the Peterson Institute, we're having this conference today. Increased capital standards for large banks also has the potential to push risk to non-banks, such as hedge funds and insurance companies. Experts appropriately ask if we substantially increase and simplify capital standards for banks, but that drives risky activity elsewhere, has financial stability really improved? That's an important question. Now, we touched on this in our May symposium, where experts discussed whether a tax on financial firm debt could be a means to level the playing field so that risk isn't simply pushed to non-banks. But then this introduces many additional questions. How should regulators size such a tax? To whom should it apply? All financial institutions or just non-bank financial institutions? And would there be unintended consequences of such a tax? These are some of the questions that we are going to continue to try to answer in our Ending Too Big to Fail initiative as it moves forward. All of this work will culminate in our recommended plan to end Too Big to Fail, which we are committed to releasing to the public by the end of the year. Thank you very much.